This is NTV.
Business Redefined, brought to you by Vuma.
Greetings and welcome to this special edition of Business Redefined, where we are still covering matters, I should say, regarding Finance Bill 2023. Ever since it dropped last week, we have been inundated with messages and questions as to what this implies as far as the taxation and operating environment for businesses is concerned. And we are delighted to have on set with us a power panel, which shall help us unpack this further. Let me start with my left, where I have Edna Gitashu from PwC.
Thank you, Julian, for having me on your show, and a very good evening to our viewers.
Karibu sana. Then CK.
Thank you very much. I'm happy to be here this evening. Thank you.
By the way, CK is Christine Kahema. You know, she has a fan base on Twitter, so... And Daniel, please.
Thank you very much, Julian. Very pleased to be here.
Asanteni sana. Thank you so much for creating time to be with us. Kenyans are asking us so many questions about the finance bill. And let me just start with the tone of the finance bill. Unlike every other finance bill I have read over the years, this is the first one which I think suggests that government needs money here and now. Let me start with you, Daniel. When you look at the provisions around withholding tax, excise tax, remittance within 24 hours, what does that speak to?
So I mean, you know, the one thing that is quite interesting about this finance bill is the fact that for a long time, as has been the position in law, withholding tax is payable by the 20th day of the following month. This is the first year where we are seeing a move for the payment date being brought forward to the next day from the date that you actually make the payment. Now, what that practically means is that anyone who makes a payment on account of certain things, management and professional fees, interest, withholding tax, interest, dividends, you name it, would have to remit the withholding tax the next day.
All right.
And we all think, you know, we've been discussing it through the tax professionals, my law firm, ELN. We've really thought about this. We think that the cost of compliance will increase significantly. Now, as we understand it, the rationale for this change is purely from a perspective that the government believes that the moment you have made the payment on account of a particular service, the tax becomes due immediately. Yep. There's no need for you to wait until the 20th day of the following month. Practically, it will make it really, really difficult for purposes of compliance for anyone to be in a position to actually make that payment by the next day.
Let me hold you there, Dan, and switch over to CK here. A very good friend, Ministry with Health, mentioned to me that, look, these entities are simply agents of collection. Yeah. They have no business deploying these taxes which they collect elsewhere. So what's the problem with us asking them to give us within 24 hours?
It's not that easy. And think about an SME who's really struggling from a cash flow perspective. You really have to plan your business, but you also are considerate about that other person who's also going to trade. So you want to ensure that you pay them on time if possible and be in a position to remit the taxes. Sometimes it's very difficult. Yeah. The fact that I'm given until the 20th of the subsequent month, it helps me as an SME comply from a tax perspective, because if I was to do it at every single point, you can imagine the number of accountants I will have to employ. It's almost impossible. Remember, a maxim of taxation is simplicity, flexibility of a tax law. You know, so when you make it payable immediately, it becomes very difficult. Now, one of the other reasons as to why maybe government would have thought about this was to ensure that they can bring a lot of taxpayers within the ambit of taxation. Maybe they may feel, if I get this tax immediately, I will know there's a service provider who exists somewhere and I should be able to go for him. That's definitely makes sense, but making it a burden on me as a person who's remitting taxes. And Amboko, remember, I am an agent and government doesn't pay me for this work I'm doing. Yeah. So it's an additional cost of business for me. If I'm to withhold the tax and remit it, becomes very expensive to run a farm. You know, the instances whereby you sit down and you're wondering, am I supposed to do my work and earn government revenue, or earn revenues for which government will get a chunk of it, or am I just going to sit here with a compliance burden? It becomes very difficult and expensive.
And let me switch gears to you, and still playing the devil's advocate here, and not really holding brief for the government, but fielding their questions here. The question has been thrown at me that, look, we have piloted this thing with the betting industry. It seems to be working successfully. We are ramping up revenues. Why not scale it after all?
So, Julius, there's a significant difference between the betting industry and the other taxpayers.
Yeah.
So, for the betting industry, there was actually integration of systems, the betting platform with the KRA platform. So, it was very easy for you to know this is how much that is due on every single day. But now for all the other taxpayers, you're telling them, within 24 hours, we don't care whether or not our systems are integrated, we would want you to pay taxes.
Yes.
And from a taxpayer perspective, taxpayers also have their own internal governance structures. I'm not just sitting there waiting for withholding tax to be paid so that I can rush and pay the government. So the taxpayers would need time also to be able to have their approvals in place.
Yeah. So, Dan, someone is asking here, so what would this mean to those of us who have been waiting for the 20th? Is that provision effectively being knocked off, or what should we expect?
So first of all, the finance bill has to be enacted.
Yeah.
The process of enactment of the finance bill will require that it goes through public participation. The parliament and members of the public are making comments. So the legislative process means that this provision could or could not be in the final Finance Act that we see. It's all dependent on the parliamentary enactment process.
Yeah.
So someone who is asking the question would need to know, for now, continue as business as usual, except for the fact that there's a possibility that it could come in. So therefore begin thinking about the systems you need to put in place in order for you to comply once it comes into force. Now, this particular provision comes into force on 1st of July, 2023, if the Finance Act is enacted in its current form. What that therefore means is that from any time from that date, any payment you make would require that you make the withholding tax payment the next day. Obviously, we do hope that there's going to be some leniency on the part of the government. Yeah. We also believe that the National Parliament will consider the cost of compliance and possibly create some leeway on this provision, so that we don't see it as it's currently drafted in the law.
Okay. Yeah. So Dan has spoken about public participation. In case you're wondering, the window is until the 20th of May, 5 p.m. You can submit your comments by sending to the email cna@parliament.go.ke. I have gone through that so many times, I know it offhand. And also, in case you're wondering about the effective dates, just go to Section 1 of the Finance Bill 2023. You shall find them there. Yeah. Let me come now to CK. Another issue which has been a can of worms in the conversation here is a proposal for pay-to-play, where you deposit in case you have any dispute as far as tax matters are concerned. And the question I've been asked is this. This thing has emerged before, been thrown out. Why is the government so insistent on this?
That's a very interesting comment, because we actually saw it last year, and it had actually been introduced again in 2015, but it didn't see the light of day. But it's because it's actually a very punitive provision, and secondly, it's unconstitutional. It denies the taxpayers the right to justice. You can imagine, Amboko, this requirement of 20% is when you're appealing from the tribunal to the High Court. You're required to deposit that 20%. Consider an assessment of $1 billion. 20% is how much? 200 million.
Correct.
How many taxpayers would have 200 million to put in as a deposit for them to be had? It's definitely discriminatory, because it does not require on the commissioner to put in the same deposit. Secondly, look at the duration it takes to have a matter determined at the High Court. Could be 5 years. The value, the time value for money, and you will have actually affected my opportunity to build the business, to be ready to pay the tax in the event that I lose a case at that point in time. You asking me to put in a 20% or to get a security, because that's a new addition we're seeing in that provision, becomes very punitive on businesses. And what will happen, as a businessman, I'll decide, I know I have a strong case, but let me settle this dispute, because paying 20%, I'd rather go and pay the 20% and maybe have an installment plan to pay the remainder of the duty, as opposed to fighting the same in court. So that denies you access to justice. And then secondly, I'm a lawyer. We thrive in building tax jurisprudence. If we will have to be settling just because of this provision, I don't think we're doing justice to our system.
And the question now here is, do we have such a load of, and I say this respectfully, frivolous petitions as far as tax disputes are concerned, that this thing keeps emerging as a proposal in the finance bill?
So, Julian, I think the thinking behind this is that we are tying up a lot of revenue in terms of disputes. And perhaps the government is thinking that they can be able to unlock part of these disputes through the deposit. But if you look at it from a business perspective, just like my colleague Christine has said, it's going to become very costly for businesses to go to litigation. Because with the example that Christine has given, this 200 million, you don't have it in business. What happens? You have to go out there and borrow. And when you borrow, you're being charged interest. And at the end, once you get you win the case at the high court level or even higher courts, we are not sure. The finance bill doesn't talk about interest. So you will have forgone interest. And that money would have been plowed back to the business for you to grow the business and perhaps even pay higher taxes to the government. So it's a proposal that needs to really be thought through. And our appeal is for Parliament to reject it.
But Edna, just before we take a break, the counter narrative would be, unlike the previous finance bill, look, we have now given you the window of a security. So forget about the 200 million shillings. You can give us a security.
But you see, Julians, for me to put in a security as a business, it has to be cash backed. I have to put money in the bank because that security could be called upon any time. And the bank needs to have the money. So it's still the same thing. I'll still have to cough that 200 million. Set it aside.
Dan, any take here?
No, I think I absolutely agree. You know, one other thing you need to bear in mind is that there's a Supreme Court decision on this issue. Not directly on the issue of security under the provisions of the TPA, but rather under the provisions of the Tax Procedures Act, but rather on the question as to whether anyone should be required to pay a security in order for you to access justice. Now, the Supreme Court has made a decision that you should not be required as a prerequisite for you to access justice, for you to make any amount of payment on account of a security for costs or a security of any nature for purposes of litigating the matter at the higher level. The one key thing that changed in Kenya was the new constitution. And the new constitution then introduced the right for everyone to access justice without any preconditions whatsoever. So like Edna says, we want to believe that the National Parliament will consider carefully. This is the third time that this attempt is being made, so hopefully it will not go through. But lawyers, accountants will be making their arguments very strongly to the Parliament that this provision should not actually be implemented.
Thank you so much. And that point by Dan takes us to a very quick break. I'm seeing a comment here. Julians and your panel, can you please get to the pay slips? Right after the break, we shall be on that. Stay with us.
All transactions with DTB are secure. Achieving more for you is the least we can do. Because at Diamond Trust Bank, you don't just bank with us, you bank on us.
Did you know that malaria is a top 10 cause of death in Kenya, with over 10,000 Kenyans dying every year from malaria? And the reason being a mosquito. We believe protection and prevention is the best cure in the fight to end malaria. Mortein Doom, with its trusted formulation. It provides protection in seconds. So spread the Mortein Doom message of how you and I can fight to end malaria. Mortein Doom, Kenya's #1 choice.
Candace, what's that?
I brought you a small bonus.
Bonus for what?
You got us 299 family dinners, 64 kisses on the cheek, 12 road trips to see grandma, 42 jokes from daddy, 49 laughs from mommy.
In over 60 years of dealing with numbers, we've learned that the numbers that matter the most to you are the ones that matter the most to us. NCBA Bank. Go for it.
You do your best out there, let us do our best in here with the disinfecting power of Jake. Because Jake cleans and kills 99.9% of illness-causing germs and COVID-19 in your home. Jake, your family's guardian against germs and COVID-19.
My skin is my identity, my strength, It's unique and deserves care made specially for me. New Nivea Radiant and Beauty Advanced Care with 5 oils and 5 vitamins. 48-hour nourishment. Helps reduce appearance of stretch marks in just 2 weeks. New Nivea Radiant and Beauty Advanced Care for your shade of beautiful.
Mortein Doom, with its trusted formulation, it provides protection in seconds. So spread the Mortein Doom message of how we, you and I, can fight to end malaria.
Mortein Doom, Kenya's #1 choice.
Business Redefined, brought to you by Vuma.
Welcome back to this conversation on Business Redefined. We are unpacking the Finance Bill 2023. Just before the break, we're touching on a number of issues, including excise withholding tax, as well as the pay-to-play provision in the Finance Bill. Now, we want to switch gears, and before we even get to the discussion around 35% and pay slips, let's get a more balanced view here. And let me just ask my panelists, and let me start with Edna. In your own assessment, what are some of the wins, or should I say good proposals, in the Finance Bill?
Yeah, so the very first one is around tax refunds. So the period within which the government is supposed to pay you the refunds has been reduced from 2 years to 6 months. That's a very welcome move. Yeah. We also see that there are incentives to the telecommunication sector. When they put up their telecommunication equipment, any civil works that they put up, there's an incentive around that. We also see the reduction of residential rental income tax from 10% to 7.5%. And I believe this is a really good measure, and perhaps it's going to bring in more landlords into the tax net.
And I see, and maybe just before I come to CK here, the issue of residential rental income tax. Someone asked, is this a reflection that, you know, there was a mapping exercise being conducted, that we feel now we are roping in a lot more people into this space? I don't know what you think.
I think the first thing is to encourage landlords to voluntarily register with the Revenue Authority. So whether or not the geo-mapping is working, the Revenue Authority has embarked on an exercise to bring in more landlords into the tax net. So this is one of the moves that is hopefully going to bring in more landlords into the net.
CK, as I can imagine, on the annual inflation adjustment of excise. I'm sure that's where you're starting from.
No, let me not start on that one. Let me start on a different one, and this is with respect to capping of interest. And this is something that really bothered SMEs in the last financial year. So currently, with the current law, what happens is that interest expense is restricted to 30% of your earnings before interest and tax. So in many of these SMEs, they are funded through debt, and mainly through local debt. So when you tell them you cannot allow the entire expense, it really hits their books and it hits their corporate tax liability. There's an increase in corporate tax. And I'm glad to say those were some of the submissions that we made for that to be reviewed. And we have gotten a change this in the bill that states that the only interest that will be restricted is in relation to loans by a non-resident entity. We were actually hoping that it will be to loans by a non-resident who you're related with, you know, but it's still a fair situation now, because you will notice that for most of the SMEs, they were in losses, but because of the add back of the interest, it puts them in a tax-paying position. So I think for me, that was one great win. Secondly, inflation adjustment, a conversation that we have had here over and over again, you know, because inflation adjustment had really become punitive for the excise industry. I mean, you will have a change of excise duty through the Section 8 in July, then an inflation adjustment, assuming that prices always adjusted through inflation. So I'm happy that that has gone away, and hopefully it will bring a lot of predictability and stability with respect to laws. Lastly, for me, I think that one of the other gains is a reduction in the excise tax paid for financial bank transactions. I mean, sometimes when you do that bank transfer and you look at the cost, you're like, oh my goodness, did I really have to do this bank transfer? So that's definitely a win.
Dan, please.
I think the new tax amnesty that has been introduced is a good thing. So the way it should work is that if you pay your principal taxes, taxes that were due on or before 31st of December 2022, you would get an amnesty on penalties and interest. Now, obviously, we want to see what that means, the guidelines that will be issued, but it's meant to encourage the ability of people to settle disputes out of court. One of the real reasons that delays people and forces people to go into disputes through the tax appeals tribunal, the High Court, and on and beyond, is the fact that not only will you be required to pay the principal tax, you will also be required to pay the penalties and interest. So if the penalties and interest can be waived, perhaps we will see more and more people actually paying the taxes. Maybe even the landlords that Edna was talking about in terms of clearing up their back taxes.
I see.
Yeah.
And in case you're wondering, I've received many questions around how does this distinguish from the voluntary tax disclosure program. In the case of VTDP, KRA has no visibility of the income you've been receiving. In this one, it's a very different matter. It's penalties, so they already have visibility. So let me come to the issue of pay slips, and let me start with Edna. One is the issue of 35%, and many people have argued that, look, very few Kenyans are in this bracket. What really is the end game here?
Yeah, Julians, actually this is not the first time that we have in this proposal. The income tax bill, the draft income tax bill 2018 had a similar provision. The only difference was a threshold. So for you to be taxed at 35%, you had to be making income of 9 million per annum, which translates to about 750,000. So it appears that this is something that the government has been thinking about for a long time. But having said that, it would be interesting to find out how much tax would be collected out of this, because you're right, not very many Kenyans would be in that category. If you look at the economic survey that was released last week, majority of Kenyans are actually earning below 100,000 shillings. So it's one of the areas that needs to be looked at. And unfortunately, it has come in with another raft of changes. Very recently, there was a decision on NSSF.
Yes. Yeah.
So NSSF payments went up from 200 to 1080, being the highest. Then we are also seeing proposals, although not contained in the finance bill, around NHIF, 2.75% of your gross, which doesn't have a cap, which is also going to be quite punitive, and the National Housing Development Levy at 3%. So the challenge we are having is that these changes are all coming at the same time. Perhaps we need to stagger them. So that at the end of the day, the employees who are paying all this still have some disposable income to consume and pay VAT or indirect taxes on.
I see. Sika, your take?
Yeah, that's interesting. The 35% is definitely very punitive. And how I look at it is that this bracket is meeting many other expenses. They're paying for themselves school fees for their children, maybe in a private school, maybe they're not comfortable with a public school. This same individual visits a private hospital. So there's a lot of spending happening at this high-end by these high-end individuals. Now, when you increase it to 35%, what you have done is that you have decreased their disposable income. And remember, these individuals are also supporting quite a number of other people. I mean, if I used to have a mama fua every week, I might decide 5,000 is gone, I cannot afford a mama fua anymore. That mama fua was depending on me. So I think it's something we really, really need to think about. And as Edna was mentioning about the other changes that have come in place, and maybe Amboko, to give you context as to how significant the impact is, and mainly if I look at it from a deductions perspective, consider Christine has employed an employee who earns about 20,000 shillings. This employee has now to pay the 1080 NSSF. They're paying roughly about 600 from an NHIF perspective. Then you've introduced a 3% National Housing Fund. This employee goes home with 20,000, if I'm, for example, to take everything into consideration, to about 17,000. 3,000 off
is a big deal for them.
It's definitely a big deal. The employee is wondering, I can't even afford my rent, and you're telling me I need to save up for a house, you know. Then remember, they're going home with 17,000, and you're proposing to increase fuel as well. This person depends on maybe 2,000 for bus fare for the month. It will go up to 5,000 because of the increases, and many other costs will happen. So we really need to think about these proposals. As Edna says, bringing them all together is definitely very punitive, and we need to see how best to increase the tax base as opposed to focusing on the 3 million who've been paying, you know, the 3 million Kenyans who've been paying the tax. I mean, we are 16 or 17 million registered voters. Why don't we maintain it as is and then increase the base? Let's bring others into the ambit of taxation. I think that's what government should be doing, as opposed to hitting the 3 million over and over again.
Dan, I'd like you to speak specifically to this issue of the housing levy, 3%.
So I think I just wanted to make one comment on the previous point. Then I'll talk about the housing levy. I think it's time for us to talk about tax accountability, and what that means is we need to see a corresponding accountability on the taxes that have been collected. The challenge that we see in this country is that taxes will be levied, more and more taxes will be levied at various levels. Unfortunately, we do not necessarily see how that expenditure is accounted for in the proper sense. We see all the scandals we see in the newspapers, and what this does is that it causes demoralization. Yeah. So if someone is paying higher taxes but is getting commensurate services for the taxes that they are paying, then they will be happy to pay, perhaps even higher rates than the 35. Other countries, we know people pay higher taxes, but they get the services commensurate to the taxes that they're paying for. The challenge we have in Kenya is that at the moment we see the scandals, and we think that this conversation must go hand in hand. If you're increasing the taxes, let's see how greater accountability for the tax money will be given. It's not possible to have one without the other. Talking about the housing fund, so obviously there is the proposal to increase, to introduce a new levy, 3%, payable by the employer and by the employee. This is capped. It's capped at 5,000 shillings, unlike the previous, unlike, for example, NHIF, which is uncapped. The one thing that we do think that requires more thinking about is how practical is it, and is it really a saving for the future? Who will be able to access it? We have seen the rules, and what we think is that, unfortunately, the same people who have had higher taxes charged on them will be contributing to the housing fund and not necessarily be in a position to benefit. Yeah. So while we understand the rationale for it, the rationale is to enable a fund that enables housing to be provided. We know it's one of the big 4 agenda items. We know that housing in Kenya has been an issue for a very long time. But the way that the government wants to go about it, which is to require that the same people who are employed to contribute towards this housing fund, may not necessarily be the ideal way to go about it. Yeah. So more thinking needs to be done. I think also we've talked about the burden on the employees, but the burden on the employers is also significant, because for an employer to suddenly pay 3% on the matching, on the gross pay of every single employee, is something that hadn't been budgeted for, is something that effectively requires them to dig deeper on the backdrop of increasing costs, depreciating currency. So we think that some of these things, will probably need some national conversation before you see how best to do it, rather than effectively bring everything at the same time. And this is really going to be one of the ones that's going to be difficult for both employers and employees to be able to handle.
But Dan, in its defense, the government has said, look, if you read the entire provision, we've given you an exit route after 7 years or retirement, whichever comes earlier. So Sike was saying, imagine you come in at 20 years. Whichever comes earlier, you can take your accrued savings and walk off or give them to a dependent.
I mean, the real question here is whether savings should be compulsory. We appreciate the fact that, the thought behind it is that, you're going to create a social good, which is to provide housing. Yeah. The contrary argument is it should not be a compulsory route that forces every single Kenyan who is employed, because the mechanisms of bringing the people who are in self-employment under the same ambit of the law will be difficult. So you will end up with the 3 million people that we have just referred to. Yeah, the people who are on payroll, the people who are going to be paying NSSF and HIF to also contribute towards this fund. 5,000 maximum cap per month. That is going to be 60,000 shillings in a year. Yes, you'll probably get your money in 7 years' time, but the reality of the matter is that it's quite a challenging way to compel everybody to do this process. Right. So if it was voluntary, then by all means, people should do it.
And now you look like you want to chime in here.
Yeah, I want to add to what Daniel has said. So I do agree, this is a very noble idea, the housing agenda in itself, but we need to think through it, For instance, the exit clauses that Daniel and yourself are referring to, if you read very carefully, so at the point when you're being deducted, this amount will be subject to tax.
That's true.
At the point when you're getting the benefit, it's still subject to further tax. So this appears to be double taxation. So what happens, like for the pensions, Pensions are an allowable deduction. So this one is not taxed, especially if you are contributing less than 20,000. It is not taxed. But at the point of withdrawal, then you suffer the tax. Likewise, if you're contributing more than 20,000, which is the limit per month, then that amount will be taxed. And at the point of withdrawal, then there's no tax. So we need to have similar structures.
Okay.
Yeah, and interestingly, Amboko, imagine if I have a mortgage.
Yeah.
I'm struggling to pay that mortgage, and the interest rates are actually going up. Would I rather save here or decide, let me take that additional 2,500 I want to pay per month, and even tell my employer, also give me your 2,500, and I use it to reduce my capital deduction in order to reduce my interest expense.
Yeah.
So it really doesn't make sense. If it has to be there, let it be voluntary, as opposed to making it compulsory.
I see. There's a question which is coming here, and really want to get all your thoughts. Maybe starting with you, Daniel. What's happening with the turnover tax?
Turnover tax.
Yes.
Okay.
And I think that the gist here is that it was really targeted at simplicity of compliance.
Absolutely.
Yeah.
Yeah. I mean, the reason why I'm finding it interesting, you know, during COVID, the idea was to lower the rate. I mean, it came down to 1%, and then also to effectively shield people who earn $1 million shillings and below from being in the band, and also increase the higher maximum to 50 million. So this is a change that was introduced during COVID. So it appears that the COVID changes have been reversed, because what's now happened is that the lower limit has been reduced to 500,000, meaning that you now have more people who are actually going to be taxed at that lower rate. Correct. I mean, at that band. And then the higher limit, which was previously 50 million, has been lowered. It's now 15%.
15 million, yeah.
In addition, the rate has changed from 1% to 3%. So the overall outcome is that you now have more people who will be effectively at the 30% band, or, you know, corporation tax, depending on whether, if it's a sole proprietor, you're going to the graduated scale. If you're a company or a small business, you go into the corporation tax bracket, and you'll be paying 30% because you have moved from being, for example, if your turnover was 20 million. Previously, you'd be doing it at the turnover tax regime. You're now under the corporate tax regime, right? So that is a significant change for a lot of small businesses, because you suddenly have to pay corporation tax at a higher range. The second thing that it does is that people who previously did not have to pay taxes through this regime, because if you earned a turnover of $1 million shillings or below, you fell completely outside the taxing regime in that sense. That lower end has been reduced to 500,000. So it seems slightly, you could argue, it's counterintuitive, because if the idea is to protect the most vulnerable in our society, then I would have thought that effectively we should be either keeping the lower end at $1 million, maybe raising it to 1.5 million. But to have both at the same time and then increase the turnover tax to 3% will probably hurt a lot of small businesses.
But just before we take a break, Edna, very quickly, in fairness to the National Treasury, I mean, the band 1 to 50 million shillings was really wide. And also government could argue, look, COVID-related tax reliefs were wound back a long time ago. We have really given you a honeymoon with this thing.
Yeah, Julian, you're right. And maybe the other way of looking at it is that this is optional. You can either be taxed under turnover tax or the normal corporate tax regime. So, and I want to imagine quite a number of the large businesses still under the MSMEs have also opted to be taxed under the corporate tax regime, where your expenses are also allowable. So, but back to just what Daniel has said, so a rate of 3% assumes that you're making a profit margin of at least 10%. So anybody who is making a profit margin of 10% and above is okay. But the real challenge would be those ones who are making profit margins of less than 10%. It would then appear to be more expensive for them to comply under turnover tax than under the normal corporate tax regime. And maybe just to emphasize, in terms of tax policy and predictability, you don't want changes to be made every now and then. So it's not very easy for the taxpayers to take two changes at a go related to the same thing. So it would have been good to graduate. So maybe this year, let's try with the rate. See perhaps whether we are going to raise more revenue. Raise it to 3%. And arguably, you can say it was a last COVID measure, so we are just reverting to the pre-COVID rate. Then next year, look at the thresholds.
Okay. Right, and that point by Edna takes us to yet another break. Now, someone is asking a very interesting question here. I've read the finance bill. Am I missing something on minimum tax, or is it not there at all? So I'll ask my panelists that question when we come back. Let's stay tuned.
It hasn't been easy to find the right diaper to protect Celeste's delicate skin. After trying many diapers, Pampers proved to be the best for my baby. I tested it myself. I placed Pampers and an ordinary diaper under clear bowls with a hole in the middle. I poured 1 cup of water in each diaper. I saw that Pampers absorbed 2 times faster. So almost no wetness can be felt on my baby's skin. I only trust Pampers for my baby. Go try it yourself.
At DTB, your dreams are our calling. If you're running a biz like Louise, get the fuel to go further with DTB's asset finance. For sunrise to sunset guys like Alex, we've got your back with extended banking hours. Are you like Sheila? Her online and offline payments are never on the line, because all transactions with DTB are secure. Being like Annette was safety nets means you can bank from anywhere at any time. Achieving more for you is the least we can do, because at Diamond Trust Bank, you don't just bank with us, you bank on us.
Jumini actress. Nadhani sina insecurities. Kuna body parts kwa itaka zionekane. Lakini after kutumia nice and lovely flawless bio body oil, results nazo, nimereclaim my confidence na nika fade away my fears. New nice and lovely flawless bio body oil. Imeboreshwa na 4 natural oils. Kupunguza stretch marks, ku-even skin tone, na ku-improve firmness. Flawless is a feeling. 9 out of 10 Kenyan women agree it worked for them.
Babe, have you heard Dance Holding by Uncle Jing Jong?
But have you heard by Mandy?
Have you heard?
Have you heard? Have you heard? Rumba
By Ashake!
Have you heard?
Bago Weapons! Have you heard? Have you heard?
Spotify has over 100 million songs.
Now, I don't know what's going on with you two, but I'll have you know that I'm watching you like a hawk, and I will get to the bottom of what's going on. Mark my words.
Kubono kindaunga. Mjua sasa mzahai jo kuna video.
Jemu, right?
Do I know you?
You were in IT class while I did procurement.
You're sitting here hitting on a woman who is clearly out of your league, while the mat sits here clearly empty. You're supposed to get out here and get every single passenger that you can in here right now.
We are calling you to be part and parcel of the fastest growing satellite town in this city. We are developing and building a beautiful Achievers Gate. This is a chance that you cannot afford to miss. Call this number 0790 300 300.
Business Redefined, brought to you by Vuma.
Welcome back to this conversation on Business Redefined. We are unpacking the finance bill, and we have done quite a conversation. Now let's just continue with it, and let me start with Edna. One of the issues which has been a sticky one in this finance bill is the standard rating of fuel at VAT, going back from 8% to 16%. In your own assessment, what's the rationale behind this?
So Julian, let me start by giving you the background of how we found ourselves here. So when the VAT Act was enacted in 2013, there was a provision, a transition period for exemption for a period of 3 years. 2015, there was hue and cry. So we continued with the exemption for another 3 years. 2018, the government proposed to then transition from exemption to 16% VAT. After a lot of public outcry, then the government decided, let's meet halfway. So instead of the 16%, let's do 8%, which has been working. But now the proposal is to then push it from 8% to 16%. So the challenge we have with that is that right now our currency is depreciating. The imports are in foreign currency. So it means that the fuel prices are also going up. Then you also look at the landed cost of the fuel itself. It's also going up. So increasing this VAT at this time, plus these other shocks that we're experiencing from a fuel perspective, means that ultimately the pump prices could be even up to 200 shillings per litre, which is very expensive. And it will have a ripple effect when it comes to the economy, because the cost of transport will go up, your food will also go up because it's being transported from one place to another. Maybe it's time also to look at the levies that we have from a fuel perspective and see, is there any headroom around those levies?
Okay. So maybe as I come to Dan on this same issue, if you remember, and just walking you back to the history of VAT Act, one of the ideas was, let's clean up the VAT regime in this country. We have too many exemptions. And also now with the 8%, we have quite a number of rates. We need to kind of harmonize this thing. What are your thoughts on this?
So I mean, you're right, you know, that the reason why they cleaned up the VAT Act, slimmed it out quite significantly, was to try and eliminate the exemptions. They did that first cut in 2013 when the VAT Act came into force. And then over the course of the last few months and years, you know, the VAT Act, the schedules to it, which set out the zero-rated and the exempt supplies, have been reduced significantly. I think just first of all, picking up on what Edna has said, I don't think there's much headroom with the levies, because you see each of these levies has a function. So for example, when you look at the cost of fuel, you have the road maintenance levy, you have the petroleum development levy, amongst others, and each of them has a role. So for example, the road maintenance levy is what is used by the Ministry of Transport to fix roads and to continue maintaining the roads across the country. So in reality, it seems that it's going to be quite difficult to have much headroom by reducing some of those levies, unless there's going to be a knock-on effect on something else. I think the real challenge we have is the fact that now with the new increased rate, harmonizing it at 16%, you then end up effectively increasing the cost of everything else, because, you know, fuel drives our economy, you know, with the vehicles, the matatu sector. So I think, you know, it's going to be a bit of a challenging time. Perhaps one could say there was no good time to remove the subsidy and to harmonize the VAT rate on fuel. But I think, you know, when you look at the economy as it stands today, the fact that, you know, the currency is depreciating, therefore the cost of oil has gone up, it's just the timing that seems to be slightly off. Perhaps one would say with hindsight, this is something that should have happened maybe a year back, you know, when the cost of international prices of fuel was lower.
Sika, let me come to you, and as I come to you, let me ask this question. In the spirit of give and take, look what's happened with the LPG. And now look at what's happening with fuel.
You know, interestingly, with indirect taxes, they affect everyone. The ones at the low of the pyramid and the ones at the top of the pyramid. Thinking about LPG, not everyone uses gas. You know, other guys will use different types of fuel. It can be a stove, it can be electricity, or any other form. So I don't think the two can be compared. You're not telling us that we are making fuel more expensive because I'm giving you from an LPG perspective. That for me doesn't work. And the thing with fuel, as my colleagues have said, it actually affects everything else. It affects cost of food, cost of transport, and many other things, even electricity, because now electricity will become much more expensive. I think it's something we really need to think through, whether this is the right time for it. Consider postponing it because of the ripple effect of that increase. I think that's something that really needs to be reviewed before it becomes law.
I wonder whether we'll ever have an opportune moment to review it, but let's switch gears in the interest of time. Value-added tax on exported services. Edna, when you look at the changes proposed in the finance bill, do you think it's a win?
So we've come a long way, Julians, when it comes to value-added tax on exported services. Initially, we started off with zero-rated, zero rating of the same, then exemption. Last year, it was standard-rated. So I think this is a good halfway house, having it exempt, but it would be good for it to be zero rated. So hopefully either through the Finance Act or in the next cycle of the finance bills, then we can see this zero rated, which is actually the international best practice. Countries world over zero rate VAT on exported services.
But in the interest, Dan, of practicality, look, the issue of refunds would then be a headache now.
Well, yeah, you could say that. I think I think it's a good halfway house. The real issue is that last year and most of this year, companies, particularly service centers, have been thinking of moving and migrating their headquarters from Kenya. And Kenya is positioning itself as, you know, a hub for providing services to the entire region. We have seen more and more multinational headquarters moving to Kenya. Because more and more multinationals have been moving to Kenya, they're effectively using Kenya as the hub for provision of all services to their related companies across the region. So to have the standard rate of VAT at 16% was extremely punitive and actually detrimental to the economy. More and more companies were actually thinking of moving to other countries that would not have that same problem. The thing though is that while we now have the exemption, and it's now VAT exempt, it's still an expense to companies, because companies that provide significant amounts of exported services, which are bringing revenue to the country, which are bringing foreign exchange to the country, will have their input VAT restricted in proportion of the amount of zero rate exempt supplies that they're providing. So I think this is a conversation that needs to be thought through, perhaps not through this budget cycle. Maybe the next budget cycle it needs to be thought through more carefully, because in an ideal sense, zero rating encourages exportation, it brings in foreign exchange into the country, it employs people who are providing services globally, and we're a country that should be encouraging exports and should be encouraging Kenyans to provide services across Africa, potentially across the whole world. So shifting it that way to zero rating will be really the way to go in the years to come.
Second.
Oh, Mboko, it's been a journey. We've been here quite a number of times discussing the same. Yes, and as Edna said, prior to June 2021, it was actually zero rated. Then it became exempt, and then, and interestingly, when it became exempt, we were really trying to build a case for it being zero rated as opposed to exempt. And what gives me a lot of hope and faith is that government actually heard us. They listened. Yes, we were really hoping that it will be zero rated. It became exempt. And I think the issue with services is because of how complex a service is for you to really demonstrate that it has been exported. You know, unlike goods, the goods actually move from one jurisdiction to the other. With services, it becomes very difficult for government to really understand, are you really exporting that service? Are you performing the service here, and therefore government decides that that is not an export of service? It's because of those complexities that government feels maybe shortchanged to some extent. They will treat it as a zero rated, you claim back your refunds, and they've got to pay refunds. Exporters of services are actually justified to be in a refund position, because they are definitely exporting just like exporters of goods. So getting to the exempt status at this point in time, for me, I am glad and I'm hopeful that as we continue having this conversation, I mean, trying to look at how other jurisdictions are doing it, and as my colleagues have said, we are in a system where we rely on the destination principle, that the country receiving the service has the taxing right. So this is a conversation that keeps on growing, but I'm happy that we've at least cushioned taxpayers. Me specifically, I feel that I'm in a better space now. With time, we will get to the zero-rated status, hopefully, but we are on the right journey.
In the fullness of time, I guess.
Yeah.
I've got a lot of questions here, and let me start with Edna, because the question here is being asked, do we still have a viable investment case in the betting and gaming industry in Kenya? You really understand where this person is coming from.
Yeah, thanks, Julian, for that. So firstly, it appears that the government believes that the margins in this sector are very high.
Yes,
if you think about the taxes that are being paid, you have your corporate tax at the rate of 30%, you have your betting or lottery tax at 15%, you now have withholding tax on winnings, and there's a proposal to increase excise from 7.5% to 20%. But it also appears that the current government is aligned with the previous government, which was trying to deter the youth from getting into betting. But this again raises a question around tax policy, because I can't remember any finance bill or any finance act that in the recent past where this sector has not been touched. Yeah, so I think this then calls for us to revive the conversations really around tax policy. As an investor, I'm making long-term decisions. I'm here for the long term. But if there is this instability in the country, then this discourages the investors from actually putting in more money into the sector.
Done.
So, you know, one of the other changes they have made in the betting sector is that they have redefined the word winnings.
Correct. And it's a big issue, actually.
It's a very big issue because my law firm actually represented a number of companies, and the matter went to the Tax Appeals Tribunal. We won at the Tax Appeals Tribunal. The matter went to the High Court on the question of as to whether winnings is inclusive of the stake or exclusive of the stake. Effectively, for someone who puts in 10 shillings and wins 100, do you pay tax on 100 or do you pay on 100 minus 10? So you pay on the 90. And the Tax Appeals Tribunal, which was then affirmed by the High Court, clearly stipulated that a winning cannot be inclusive of the original amount that was put in, right? Now, the amendment that has been introduced or proposed to be introduced in the Finance Act says that winnings includes, now it talks about lotteries, talks about the usual betting, but it says without deducting the stake or the amount staked or the amount wagered. So what that effectively means is that despite a number of court cases on this particular issue, the law now seems to be veering towards the direction that the winnings will be taxed as a whole, not deducting the amount staked. So it's actually quite a complex area. I think it's an area which, as Edna says, has had so many changes. Every year you see a new change.
Yeah.
And this one in particular, together with the excise tax at 20%, is likely to sound the death knell on this sector. Now, one of the things that has been quite clear, and people have looked at the statistics, they have shown that the fact that there has been a higher tax has not necessarily resulted in additional tax revenue for the government. In fact, it has the contrary effect, because the higher the tax, the less inclined people would be to bet. So what that therefore means is that there has been a shrinking of the entire revenue the Kenyan government is collecting. This is one of the sectors where they probably want to ensure that they sort of don't overtax it if they want to collect taxes from the regime, from the sector. Obviously, if the intention is to discourage the youth from betting, then you can understand the changes. But if the intention is to collect taxes, then one would think that they would be better off, particularly on the excise duty, to leave it at the 7.5% that it was, than to increase it to 20%, because overall, the taxes collected by the Kenyan government will reduce.
Sike, people have argued that you need to choose your poison. If you read this finance bill, we have given you a breather on other sin taxes. Names withheld. We are really focusing on this one. Do you think it's a fair straddle?
I think it has to be a balance. And when we look at the other sectors, yes, I think the government has been lenient to some extent, but it's because of the kind of work that happens in those industries. I mean, most of them are in the manufacturing sector, and they support an entire value chain. So when you look at an increase in tax in that sector, it doesn't just affect the company or the individual buying. It actually affects an entire value chain. Now, that said, sustainable taxation, Julians, is extremely important. This sector, the betting sector, definitely supports government. There are people depending on that sector as well. Not as many as in the manufacturing sector, but that doesn't mean that you tax it to death. You know, you have to do it to some extent. An increase from 7.5% to 20%, that's more than 150% increase in excise, is extremely punitive. And remember, that's not the only tax that is affecting this sector. The betting companies pay corporate tax as well. Then there's a 15% withholding tax. There are just too many taxes in the sector. If it is to thrive, but within a certain cushion, I think you've already applied the taxes that which will deter them. I think any other tax for this sector will get to a point of tax maximization, and they will not be able to do business anymore. So there has to be a balance. As much as we want to expand the tax base, let's do it to some certain limits so that those businesses still thrive, to give you the little that they were giving you, as opposed to killing it and they can't give you any more.
Okay.
Yeah.
And let's switch gears. Someone here was asking, please, can you address the issue of digital content creators? Ni kama tutaumia. So first of all, just what is provided in the law, and are there any thresholds? Because I think that's where they're coming from.
Yes. So, Julians, this is one of the proposals that has been put in place to broaden the tax base. So remember, besides deepening of the tax base, we've been talking about the increase of the tax rates. Yeah. I think in all fairness, the government is also trying to bring in more taxpayers into the tax net. And this is one of the proposals. So the proposal is that there will be a withholding tax at the rate of 15%.
Yes.
So long as you're earning more than 24,000. So one of the questions around the withholding tax rate, it's quite high. Because if you look at other resident companies, the withholding tax rate is at 5%. And 15% assumes a profit margin of about 50%. Yes. So it's something that probably we need to look at and say, yes, well, we've expanded the tax net, but is this the right rate? Should we probably start with a lower rate of 5%?
Dan?
Well, the wording is very wide, yeah, in terms of the law. So there's a new definition of digital content monetization.
Yes.
And that includes payment for entertainment, it includes sponsorships, it includes any brand, any brand promotion. So all that is caught within that definition. And don't forget that the requirements with respect to the withholding tax and the payment by the next day also applies to this sector, to this new law. So on one hand, you can understand, because what Kenya has been doing systematically, and perhaps we'll also come to cryptos, because cryptos are also caught under the new definition of digital assets. But what systematically the Kenyan government has been doing is that it has been looking at the digital economy. And by looking at the digital economy, it has been saying this is a relatively untaxed region, and we now need to see how we can monetize it. So it began with, for example, digital service tax a few years ago. On the VAT side, there was taxation of electronic services. We have now come into the realm of digital content providers who will now be caught by the tax ban, and also the cryptos, which is a big area as well. And apparently Kenya is one of the leading jurisdictions in the world where cryptos are actually quite popular. So you can understand the government's rationale that everybody needs to pay their fair share, even if we put it that way, of tax. I think moving to 15% is quite high when you look at other types of withholding tax. So for example, if you look at management and professional fees, the rate for withholding tax on residents is 5%. So 15% seems to be quite high. And unless it is the intention of the government as well to say that the 15% is a final tax, of which it hasn't said so. So that presumes that 15% upfront, another 15% will be paid together with your usual final taxes, income tax and corporate tax. I assume that for the younger people who are in the creative sector, they will see that as quite a high jump up. And I also think that if it's not properly thought through, could sort of demotivate it's a nascent sector, which needs to be promoted and cultivated and enhanced.
Okay. Sike, we have a minute to break. Just
okay. No, that's a very interesting conversation with respect to the digital tax on content creation. You know, Amboko, we from our tax laws, we are taxed on income derived or accrued from Kenya. So these people should actually be under the ambit of taxation. And I think what the government is trying to do is expand the tax base in order to bring them into this system. But 15% will definitely discourage them. You can imagine for normal advertising, withholding taxes at 5%. For these individuals, 15% is 3 times. You can imagine a content creator who hasn't been paying tax. Now you're taking it to 15%. And as he said, the Act doesn't talk about it being a final tax. It's an advanced tax. This individual is supposed to prepare his returns at the end of the year, take a deduction of expenses, compute his corporate tax at 30%, and then offset the 15%. I think that 15% rate needs to be reconsidered. Either they make it a final tax like we have for qualifying dividend, though a lot of guys would move into this space of digital space as opposed to being in the normal advertising sector, or reduce it to 5% and try as much as possible and bring them into the tax base. I mean, the way you bring people into the avenue of tax is to make it simple and at the same time make it affordable, to change the culture of non-compliance to compliance. Yeah.
Right, and that point by CK on the digital content tax takes us to another break. When we come back, we shall take now closing remarks, and more importantly, I can see many questions around where does all this fit within the draft national tax policy and what became of that document anyway. We'll be discussing that after the break.
All transactions with DTB are secure. Achieving more for you is the least we can do. Because at Diamond Trust Bank, you don't just bank with us, you bank on us.
Who is a true partner? They go out of their way to help you. They do not hesitate to go the extra mile. And they're always there standing beside you. They step in when you need them the most. Because a true partner is a partner for ground. KCB Bank.
With Molfix pants, changing diapers is now very easy. I tear and take off the used Molfix pants and pull the new one up in a moment. Wrap up the used diaper and throw it away. Come on, mothers, try Molfix baby pants and be part of our happiness movement.
How do you keep your toilets clean?
I use normal detergent and bleach for washing.
The detergent and bleach cleanless can leave behind yellowness, rust and germs. Harpic's 10 times better cleaning compared to regular detergents and bleach, and kills 99.9% illness-causing germs in your toilet, including the COVID-19 virus.
This is NTV.
NTV Tonight Headlines in association with NCBA Bank.
Tonight,
badala wapige wenye wanakimbiza wanakuja kupiga mwenye kwa safari yake.
Caught in the crossfire, Form 2 students shot dead in Kisumu as police engage traffic offenders in running battles. Also tonight,
we've been able to exhume 21 bodies today.
I am afraid that we have many more graves in this forest.
The Shakahola horror continues. 21 bodies exhumed from mass graves, with the exhumation exercise entering the second phase. Plus,
walipoteza watu watatu. Kukasalia kijana angeweza kukaa pale.
5 years on, remembering the victims of the Solai Dam tragedy, as survivors struggle to pick up their lives. And striking a balance between the tax burden and government spending, with all due respect, tonight.
NTV Tonight Headlines in association with NCBA Bank.
In over 60 years of dealing with numbers, we've learned that the numbers that matter the most to you are the ones that matter the most to us. NCBA Bank. Go for it.
How do you keep your toilets clean?
I use normal detergent and bleach for washing.
The detergent and bleach cleanless can leave behind yellowness, rust and germs. Harpic's 10 times better cleaning compared to regular detergents and bleach, and kills 99.9% illness-causing germs in your toilet, including the COVID-19 virus.
Getting hold of a playful baby to change their diaper can be difficult. With Molfix pants, changing diapers is now very easy. I tear and take off the used Molfix pants and pull the new one up in a moment. Wrap up the used diaper and throw it away. Me and my baby are very happy. This is how the Molfix happiness movement spreads. Come on, mothers, try Molfix baby pants and be part of our happiness movement.
Oh, yeah.
Friends becoming family. Home-cooked meal, ice-cold Coke. That's the recipe for magic. Make your mealtime more magical. Buy any participating pack. Check under the cap to get your code and stand a chance to win free food shopping for a year, plus millions in instant cash, airtime and shopping vouchers.
Business Redefined, brought to you by Vuma.
Welcome back to the tail end of our conversation on the finance bill. Now we have about 13 minutes to go, so we shall make this really snappy. Let me just take a question here and throw it at CK. Someone is asking on Twitter, I would like to know how the government will make sure that a content creator actually paid the true and honest figure.
Okay, interesting, Julius, because actually that's the rationale behind withholding tax.
Yeah.
Because withholding tax is payable by the person who's actually, the person who received the service. So if you're a content provider and what you do, you bill me, you send me an invoice, instead of me paying you whole, like 100%,
Yeah.
I will pay you 85% and I will remit the 15% to the government. What does that do? Aha, the government realizes a content creator exists somewhere.
Yeah.
So what will they be doing? They will be following that pin to confirm at the end of the financial year, he's disclosed his entire 100%. So withholding tax has the effect, and this is where government makes us agent to collect the tax on their behalf and bring taxpayers into the ambit of taxation. So that's how the content creator gets into the tax space and will therefore now have to account for that income. Previously, what would happen without the withholding tax obligation, Julius, I would pay you 100%.
Yeah.
Government won't know you exist, so that becomes an issue for them. And then secondly, as a content creator, maybe I'm not even keeping my proper books of accounts. I may not file my tax return at the end of it. So with government trying to expand the tax base,
yeah,
that was definitely coming, because definitely content creators do make quite some money as well.
Now, let me come to Edna very quickly. And the question here being asked is, when you look at the finance bill in aggregate, are we moving closer or further away from the draft national tax policy, which we saw last year?
Yeah, so Julian's good question. So I think the first thing that we need to ask ourselves is, where are we from a national tax policy perspective? So it was released last year. We had a round of public participation, and we were hoping that it would actually be released to the public as a final document, and it would guide the drafting of the finance bill. Because we have seen some provisions that were actually contained in last year's finance bill, a lot of cleanup, other proposals that were rejected that have found themselves in the finance bill 2023. So the benefit of the national tax policy is that it's going to create predictability for the investors. And as the investors get comfortable with the business environment, your businesses thrive. And ultimately, the government will be able to collect more taxes. Yeah. And there'll also be more employment opportunities for the youth. So our appeal is that let's fast track on this draft national tax policy. I'm hoping that it is going to be released together with the budget documents in June.
I see. Dan, help me respond to this guy who is asking, for us in the crypto space, should we be worried?
Well, I wouldn't say worried. I'll just say, you know, I mentioned there's a new
digital assets.
It's called digital assets tax. It's meant to attach to NFTs, you know, non-fungible tokens, cryptocurrencies, and a whole raft of what you'd consider to be intangibles, right? And under the way it's being structured under the finance bill, is that anyone who makes a gain on a transfer, the fair market value of that gain will be subjected to a tax of 3%. And you know, there's still complexities around it, because first of all, cryptos are a fairly new thing to Kenya. While it is the case that Kenyans are very good at embracing new technology, as I mentioned, you know, between Kenyans and Nigerians, probably with the two leading jurisdictions on the African continent, on matters crypto, in terms of how this has been adopted.
Yeah.
But the challenge will be that, and also, well, right now I understand there's a downturn, but there's a time when people made a lot of gains, significant gains on cryptos. So I think where the Kenyan government is coming from, it's simply saying, if you make a gain, we will tax it at 3%, right? You could argue that it's still much better taxing it at 3% as compared to a capital gain, for example, on immovable property. If I sell a property today, it's 15%. So the rate is it's significantly lower, 5 times lower than on immovable property. But there are going to be complexities, challenges. For example, if the person who needs to pay the tax is an unresident, how do you apply that? How do you bring it into force? Questions of detectability. Unlike, for example, the context in the case of content providers, where the person who is making the payment has to withhold. In this particular instance, the person who needs to pay is the person who has made that fair market value gain. So computing it, determining how much it is, paying 3% will be something that will be difficult to do. So I suppose it will be really a question of an analysis of people's lifestyle. If your lifestyle suddenly changes and they realize that it is tied to cryptos, then that's the way it's going to be picked up. But you can understand the rationale for the government in terms of applying the tax to it.
So we have about 7 minutes to go, so I want to get your closing thoughts. And as you give your closing thoughts, there's a question which has come here, which is, we've had this discussion before. Is it time we just overhaul our Income Tax Act?
Yes, so I'll start with the latter point around overhauling the Income Tax Act. So this journey began many years ago. Actually, if you look at our acts, they are fairly new. We have managed to modernize our acts, save for the income tax. So we had the draft income tax bill in 2018. Then in 2020, during the COVID season, there was a bill in Parliament which was withdrawn. So I agree, it is time for us to actually overhaul the Income Tax Act, because if you look at it structurally, when it was enacted in 1973, Julians, I'm not sure you were born. Yeah, Kenya was an agricultural country. The main activity was agriculture, and we were beginning to do a bit of manufacturing. But now we've become more sophisticated, especially the service industries, the things we're talking about, cryptocurrency, digital content creators. So probably the law should reflect the current day economic realities. In terms of my closing remarks, what I would say is that there are some good provisions contained in the Finance Bill 2023. What we are asking the government and the members of parliament during the public participation phase is, let's strike a balance. We do understand where we are at as a country, but let's try and see how can we strike this balance so that we are not overtaxing people, but at the same time we are raising revenues and the government is able to continue rendering services.
All right, Sika.
Julians, it's a 3.6 trillion budget.
Yes.
And therefore, it was expected that we should be seeing some increases in taxes. However, we really need to be very careful how that is done so that we're actually not even reducing the collections due to the process. For me, I think my parting shot will be to encourage individuals and corporates to participate in the process of public participation. It is our constitutional right under Section 118 and 119 of the Constitution. From the finance bill, you will see some of the proposals that we made during the earlier stage of the budget cycle were taken into consideration. This is a time for us to come back again. As you said, we're required to put in our submissions by the 20th. There are some provisions in there that are good, but others we really need to think through. For example, the paying of the taxes immediately, that will actually be very, very difficult. The withholding tax on content creators, reduce it. As I always say, government does not understand business as much as we do and as we understand it. So let's take the opportunity to go into public participation. We are really looking forward to meeting the members of parliament and the Committee of Trade and Planning to share our ideas on how we can have a win-win so that you don't have a proposal that kills us immediately. You know, we should be trying to create an environment where businesses thrive and they will get their fair share of tax, and we are willing to assist government in coming up with proposals to increase the tax base.
Done.
Let me first turn to the question that Edna touched on, which is it time to overhaul the Income Tax Act? So I would agree that it's time. The only thing I'd say is that first we need to finish with the tax policy. Because if you do not understand what is the tax policy, what are we saying, which incomes are taxable in Kenya, which incomes are not taxable in Kenya, it is difficult for you to overhaul the entire Income Tax Act. Over the course of time, we have seen provisions from the Income Tax Bill being introduced in piecemeal fashion. So we have, you know, it's almost like pouring new wine into old wineskins. That's what's been happening. But I think if we finish with the tax policy, then we can go to the process of changing the new Income Tax Act. I think as my final comments, what I'd say is that, you know, you can understand that the government really needs to collect the taxes. The reality of the matter is that when you look at the global economy, if you look at the more recent comments that came from the IMF, it is clearly the case that Kenya needs to continue ramping up its efforts in being able to be a sustainable country, self-sufficient, and generating the taxes. There has also been a very, very long argument that the same people have been paying taxes. So the need for us to, as a country, to broaden the tax base is important. So you can also understand the rationale for things like, for example, digital content being brought into the tax ambit, the cryptocurrency being brought into the tax ambit, because it is generally the case that without widening the tax base, the same people, the same companies end up paying a lot of tax, carrying the burden unfairly, which doesn't work. But we do also think that from a practical perspective, in as much as we are widening the tax base, and in as much as we have, one of the most far-reaching finance bills that we have seen in maybe even 10 years, the reality of the matter is that some of these measures need to be thought through, be brought in systematically. We need to ensure that we're nurturing certain sectors. We need to ensure that we're not overburdening those people who are already paying high taxes. And we must think futuristically. Where will this finance bill leave us as a country in 5 years, in 10 years' time?
Okay.
Thank you.
Thank you so much, and thank you to my panelists, Edna Gitachu, Christine Kahema, Daniel Ngomi. There's a saying that goes that the art of taxation is about getting the most amount of feathers with the least amount of hissing. So we hope that we shall send our comments by the 20th of May, and that shall be taken into consideration. Another issue which has been raised, which is normally a very touchy one, is about amendments on the floor of the House. Once all this has happened, including public participation, we shall continue highlighting these issues. Stay tuned. News is up next, and James Smart, incidentally, will also be having a conversation on the finance bill with 2 economists on set. Stay tuned.
Business Redefined, brought to you by Vuma.
Fanya transfer to any bank ni kuvuma.
To join, dial *844# and download the Vuma app now. Load cash to your wallet through Vuma agents or your bank, or go to your nearest KCB bank branch, ATM or agent. Let your money flow with Vuma.